We have with us Girish Kousgi, MD and CEO at PNB Housing Finance, joining us live, sitting right next to me. So first off, welcome, sir. It's great having you for a physical chat here in the studio. I want to quickly first ask you, this 3% sequential growth looks strong, given your base of nearly 80,000 crore. Would you believe that this is going to be something that is going to happen on a sustainable basis despite challenges coming both on macro as well as on micro, on the lending front? You believe that a 15 to 17% growth is sustainable, and for how many years are you looking at this kind of a growth?
Sure, thank you so much for having me here. It is not 3%, sequential growth is 4%.
4%, yes,
4%.
3 point, yes.
If you look at demand for housing, it is still there, it's intact.
Yes.
Now this year, there were a lot of challenges. We had general elections, we had heat wave, couple of states, they changed the registration process. There were climatic related challenges in couple of states. In spite of all of this, we were able to surpass our annual guidance of 17% growth on retail book. So this will be sustained, and the demand is only going to go up in the coming years. At least I see this demand for next 5 to 6 years time. So this will, I know that economy, there are certain challenges, right? I think certain sectors are not doing well. Rural was not doing well. Now it started looking up. I'm aware of all of those things. But talking about mortgage, we've seen all the 4 segments: super prime, prime, emerging, and affordable. Barring temporary challenges because of the ones which I mentioned, I think demand is intact and it is sustainable.
Okay, and what has changed, sir, in terms of PNB Housing Finance's outlook? You've taken over in terms of leadership. You've obviously brought in more stability to the ship, but what has changed that gives you the confidence that you will lend? Are you going into deeper geographies? Are you being more proactive in terms of tapping the existing customer base? Are you going out looking for new customers? What's changed that gives you this confidence that growth is there? So
basically 2 years back, the growth on retail was flat,
right,
or negative. Last year, we grew by 14.1% on retail. Last year, the growth was 10%.
Yes.
Last quarter, it was 16.2%.
Yes.
After quarter 3, we are at 17.5%. So we have done multiple things. One is we completely exited super prime. Yes. That's because of margin reasons. We started affordable in Jan 2023, and as of March 24, the book was 1590 crores.
Okay.
This year, in 9 months, we have doubled the book.
Yes.
Now the book is 3,838 crores.
Yes.
Right. This year again we started emerging vertical.
Yes.
Right. So we've added branches. 2 years back we had 100 branches. Today we have 305. And by March, in next 3 months, we are going to reach 350 branches. Yes. So we have expanded a branch network. We have changed segments. We got into newer segments. We have come out with certain new products. We also added our team. So all of these things, coupled with robust demand in real estate space, the industry will do well, and that's the reason most of the companies are doing well. This year is an exception because of all the challenges, but otherwise, even this year, few companies have done well. You take PNB, quarter 1, quarter 2, quarter 3, all the 3 quarters we have done well. We have surpassed a target as well, right? So,
right. Yes, it's an impressive set of numbers, viewers, and just for clarification, 2.5% on ROA, and they've been able to sustain that. And that's my next question, sir. Credit costs have been benign for you, which has aided the ROA number. I wouldn't attribute it entirely to be the reason why ROA has been able to sustain at 2.5. But it's aided the ROA number. For how long will recoveries continue for you? What is the quantum that you are expecting? Because you have a large book in terms of recoveries, which in the pipeline as well. So how quickly do you expect resolution? Just give us visibility for FY26, FY27 if at all you have. And therefore, ROA at 2.5%, is that aspirational or is that doable?
So, for a minute, let's assume that we don't have a write-off pool.
Fair. Okay.
Right. Steady state.
Right.
Steady state. Our ROA will be in the range of 2.5, 2.6.
Okay.
Number 1. Number 2, you look at the margins. we've been pretty consistent over last 6 quarters.
Yeah.
We are between 3.6 to 3.6566.
Yes. Very steady.
So I think this will continue, and credit cost on a steady state, it is going to be about 25 bips.
Okay.
So today, because of recovery, it is negative, maybe 19 bips this quarter, last quarter was 24 bips. Once we are done with the recovery pool, credit cost is going to be 25 bips. And margins for FY27, for example, NIM is going to be 4.1.
Okay.
4.2.
Okay.
Today you can take it as 3.5, 3.6.
Yes.
So by FY27.
And that will come from affordable housing, sir?
That will come from affordable, that will come from emerging,
Yes.
that will come from reducing our pace on prime.
Okay.
Because now we are not growing that book very fast. If you see, the growth is 11% in prime. Emerging is 19% and affordable is more than 200%.
Yes.
Right?
Yes.
So the mix will keep changing. The contribution from affordable and emerging will increase, and we're going to start corporate. That will aid margins as well. So all of these things will ensure that we'll be more profitable and ROA will be maintained.
Give us a sense of the mix, sir, by FY27. You've given a NIM number of around 4.1%. How will mix shift?
So on affordable, now the book is 3,838 crores. By March, we'll get to 5,000 crores. By FY27, the retail book is going to be 1 lakh crore.
Yes.
Out of 1 lakh crore, affordable will be 15,000.
Okay.
Emerging will be 25,000 crores.
Understood.
And balance 60,000 will be prime. So we will have 1 lakh crore retail book. Corporate, now the book is about 1241 crores, 1,240. At its peak, it will be less than 10%. Maybe by FY27, about 7 to 8,000 crores. So total book of lakh and 8,000 crores by FY27. That's the plan.
So please tell me if I'm reading this right. And on a steady state basis, post your recoveries, and I'll come to recoveries again because I want that number.
Sure.
but on a steady state basis, 25 bips with regard to your credit cost on a normalized basis, FY27 onwards, you'll still do an ROA of 2.5 to 2.6, and that incremental 25 bips will actually be coming from your net interest margin, which will be higher because you are doing affordable and emerging.
Right.
Is that the right way to look at it?
Yeah, I'm only saying that once we we have a rate of pool of 1250 crores in corporate.
Perfect, yes.
Assuming recovery rate of about 66-67%,
Okay.
we'll be able to collect that in next 3 years.
Okay, understood.
On the retail, we have 450 crores.
Understood.
So we will be able to collect that in next 5 to 6 quarters.
Understood.
Once this recovery pool is completely done with, then stand alone credit cost is going to be 25. It's not after FY27.
Got it.
It could be FY27 itself.
Understood. Okay, excellent. I've understood this right. And last off, the recoveries. How will that number be both in FY26 and FY27? Because you're still in that phase where recoveries are on and therefore provisions are credit costs are subdued. They're negative currently. What will that number be largely? You can give us a band also.
So I mean, we can take, this year, first 9 months, we've done about, on retail, we've done about 130 crores. So quarter 4, we might do another 50-60 crores. So that will be about 180-190 crores.
Understood.
Now this retail for next year is going to be almost on similar lines.
Got it.
And FY27 will be obviously less because we would have exhausted that. On corporate, as I mentioned to you, I think FY26 will be pretty good because the recovery is going to be quite substantial.
Okay, interesting. Mr. Kousgi, it's been a pleasure, trying to break this down. Thank you so much for coming in, joining us. I'm going to quickly take a question with Anirudh. Anirudh, housing financiers in general, PNB Housing in particular, your views, because some of these have come off from their highs in terms of valuations. They still offer good growth rates. They offer good opportunity. Asset quality continues to remain robust. So when you're thinking bottom up, why wouldn't you have a housing financier in your portfolio?
Why not actually? So that is housing finance for us is a key theme where we feel that it's one of those themes where, as you rightly said, growth is intact and you are starting seeing value. So housing finance for us going forward for the next couple of years should be a very, very good bet. We were
Well,
analyzing all these companies, PNB Housing, Canara Housing, and a few private lenders, very, in detail. And I believe should be one of the bets of our portfolios going forward for the next couple of years.
okay, excellent. Thank you so much, Anirudh. Of course, stay with us.